Oh, sorry, today is not February 10th, today is February 7th. Casting ahead to Monday. My name is Paul Foley. I'm the commissioner, one of the commissioners of the trust fund, and with me today is and so for the first time in a long time, we have a full board. Going around my table from the left to the right, if everybody could just identify themselves.
Francisco Hernandez, the treasurer and collector.
Welcome.
Ryan Chandler from Bartholomew Company.
Welcome. Alex Bartholomew from Bartholomew. Welcome. Chipper Gurley, CFO. Welcome. So our first order of business is each of us has received the minutes from our last meeting, which took place on June 14th, 2024. I'll ask each of my co-commissioners whether or not they've had an opportunity to review those minutes.
Yes.
Okay. And so I'm going to move to accept the minutes as recorded. Can I get a second? And all those in favor say aye. Aye. That concludes our first order of business. Our second order of business is that obviously we have folks with us today from Bartholomew Company who are going to give us our quarterly review. I see that we've been presented with a quarterly review packet dated December 31st, 2024. And without further ado, I'm going to go ahead and turn things over to the folks at Bartholomew Company.
Well, thank you. We appreciate it. It's been a little bit since we've been together. We've sent this package to you electronically, and as well we have the paper copy here through December 31st, 2024 as requested. We're going to continue to do that quarterly, but we're going to meet semi-annual or unless you change it.
Okay.
That's what we work for you with that. We have Alex Bartholomew and myself here today to go over review and markets through December. We'll give you an update on where the markets are, as well as, we've had a better market in January. We'll give you a glimpse of that as well. I'm going to turn it over to Alex Bartholomew. Go ahead.
Good afternoon. Thanks for having us, as always. Yes, what we have in front of you is the end of calendar year 2024, which is important because I believe that's how this commission tends to look at annual spending. So this is an important meeting every year in the first quarter to see what balances were at the end of the calendar year. So we gave you our prints out here, which this was provided hopefully to everybody digital in advance, right? Had an opportunity to perhaps look at it, but in the fold, when you open that right up, it actually conveniently opens up to our portfolio review and the value of the trust funds.
Where the staples are.
Okay. So as of 12/31/24, the portfolio value was just over $16 million at $16,276,000. And as we turn the page to page 3 here, that is an increase over the calendar year of almost $1.8 million from 14 million change at the beginning of the calendar year. What we're going to see here is during the balance of the calendar year, equity performance was very good. On a continued rebound from 2022 off the back of 2023. And fixed income continues to be challenged with rate expectations, inflation expectations, which we can cover. There's a lot of volatility in a lot of that data here in the first quarter of 25, so we're certainly not out of the woods on that yet. But this diversified portfolio, which is targeting a risk profile of 60% in equity, 40% fixed income, which is generally historically considered to be moderate from a qualitative perspective, did very, very well. So when we look at page 4 to start looking at performance, that return, that $1.8 million is representative of 12.33%. Now, as we know, we are overweighting dramatically what's determined to be value equity, dividend paying equity, and while we have some exposure, we're underweight both. So this portfolio is also leans domestic based off of our considerations with the commission over the last couple of years. One of my recommendations going forward for reporting through the new IPS is to update some of this benchmarking to reflect that. Right now, our benchmarking is global, and we're now only domestic. So that will change not the performance of the portfolio, but the way we view it going forward. Okay, so that's one of the changes that we'll make on March 31st, unless anyone has any questions or concerns about that. So what it does is I take the global equity index and I replace it with Russell 2000.
Okay.
Values.
Making it more applicable to how your portfolio is operated.
Right.
Overall.
And as we've seen for really going on well over 15 years now, since the great financial recession of 08 and the early 2000s, domestic equities continue to outperform international. A big reason for that isn't necessarily that companies outside the US are not worth investing in, but the strength of the dollar as an American investor has made it very challenging to have active currency translation returns that are better than domestic. Granted, as we all know, some of the biggest, most successful companies in the world are here in the US. There are many successful companies outside of the US, but they even can't compete from an investor performance perspective. Okay. So, updated benchmarking to reflect how we're investing in the portfolio now will, change the conversation or could change the conversation of how we're looking at things. But where we stand right now, this portfolio dating back to inception in 2017 with Bartholomew Company is annualizing 5.7%. The benchmarks that we're using now are between 4.6 and 6.5. The most applicable being that value index of 4.6%. So certainly outperforming over the long term, and 3 of the last 4 years have been very, very strong performers in 21, 23, and 24, with the exception of 2022, given inflation risk in that year. So the changes we made in the portfolio are not substantial in the last 12 months. Some security selection changes, rebalancing in equity positioning, rebalancing fixed income positioning to take advantage of where yield levels are. We are dramatically underweight corporate credit on the fixed income side as an example because of tight credit spreads. What that means is what you're getting paid by a corporate bond is not materially different than what you're getting paid to own a treasury or an agency. That's called the spread over it. And those are at historical tights. It's never been tighter to own a corporate bond than a treasury in history. What does that mean? It means that there may be opportunity elsewhere. So that's where you're better off just owning treasury. So that's really how we're positioned. We are overweight quality and a little bit of interest rate sensitivity on the fixed income side, given where the yield levels are now after 2022. The benefit to that is if we have a risk event, equity sell-off, risk asset sell-off, we're positioned very well to protect. The risk to the current positioning is if inflation reaccelerates and interest rates go back up. As interest rates go up, prices go down, we will be sensitive to that on the margin. But we think that this is the most prudent thing to do in diversified portfolios for all of our clients, which is take advantage of where interest rates levels are now and protect against where equity valuations are. Equity valuations after the last 2 years have become very stretched, certainly from an index perspective. Corporate earnings during the first quarter reflective of the fourth quarter, and then subsequently in the second quarter reflective of the first quarter, are going to be very important as we determine what equities are going to do in 2025. The labor market is really on the hot seat, and CPI, inflation readings are really on the hot seat, where we continue to see inflation go down. I don't know if I can turn your attention earlier in this printout with these page numbers not labeled, but we're going to go to economics and markets and just give you, again, the high level strokes here. Turn your first page over to get to inflation here. It looks like this. We continue to have inflation as measured by the consumer price index, both on a headline and core, which is less food and energy, come down from its heights in 2022. Now the debate is whether inflation is going to stay where it is, get closer to the Federal Reserve's mandate, self-imposed mandate of 2%, or re-accelerate to go higher. The market is on a day-by-day basis trying to sort that out. what are the factors that the market is pricing in? Labor market is huge. If the labor market remains strong, then forecasters can factor in continued spending, continued demand to drive prices up or at least maintain prices. If you see weakness in the labor market where there's layoffs, unemployment rate goes up, job listings go up, new jobs added go down, that could decrease consumer demand and therefore actually help in inflation expectations. Today, we had a lot of job numbers, as an example. This is just a convenient example. While we had more jobs, unemployment claims yesterday, which is a bad thing for the economy, they were modestly so. Today, the jobs report came in far below expectations. The revisions from December were revised up, so we have good news and bad news. And the unemployment rate actually went down from 4.9 to 4%. So we are starting to see some bad news. We still have some lingering good news, but there are cracks in the labor market that we are watching closely. The market is watching closely. And if we start to see weakness in the labor market, then we can anticipate at a certain point the Fed will have another reason to continue cutting rates. Not only is inflation continuing to head downward, but not only can cut rates to support the rate.
Does that then like advocate for more of a move into bonds?
So there's obviously on a long-term perpetual portfolio, we're maintaining our risk profile appropriately. We're not making bets one way or the other to a large degree, but it's how we're positioned in those buckets. So as I was saying earlier, if I was worried about rising rates and inflation, I would want to position myself on the shorter end of the curve, buying 2, 3, 4-year bonds that have very little interest rate sensitivity. If I am concerned about risk assets, equity valuations, say the S&P 500 go down 5, 10, 15, 20%, I would want to buy further out because of that diversification. Yields go down when stock prices go down as a diversifier position. Outside of interest rates. So where we're positioned,
the same dynamic holds on the interest rate side. So if we're going to chase interest rates, staying nimble in one scenario versus investing longer term.
Yeah, and so part of this is obviously positioning yourself, but it's also diversification. So we have exposure to the short end of the curve, we have exposure to the long end of the curve. We have exposure to high quality bonds and low quality bonds. But we are more than we've been in a very, very long time, overweight and concentrated in higher quality, intermediate, a little bit longer than intermediate duration, and far underweight, high risk, lower credit quality. You're getting paid more, as you always are, to buy lower credit quality. We just don't think that it gives you the value because of how much you're getting out of a treasury or an agency or other types of high quality fixed income. So we're protecting inside of the bucket instead of putting all of our chips in that bucket. If that makes sense. Okay. So at the end of the day, we don't know. The market is obviously very volatile right now as we enter a new administration. Things are changing rapidly, things are changing daily, and the data releases that will come in the coming months and quarters reflective of what we're experiencing right now, as they always are, will be monitored very closely. But our expectation is that a lot needs to go right for equity prices to have another good year, which is reasonable. And while it is a risk, we don't think that the administration's goal is certainly to reaccelerate inflation. Tariffs have been number one on the reason why inflation could reaccelerate. It will take time to see whether that's true or not. And obviously, we don't even know what the tariffs are going to be when it's all said and done because there's still negotiations going on. So as they're announced, the market reacts. As there's a pause, the market reacts. That will continue to happen until we know where everything settles. All right. So how does that pertain as trust fund commissioners? what would I wanna know? I would wanna know that the portfolio has performed very, very well since the volatility of 2022. That should be reflected in your ability to spend, when requests are made. It is still long-term, but we could experience bouts of volatility this year if something happens. And where valuations are, that is not an unreasonable expectation. So, in the constraints, in the ability that we have for the investment policy statement, we think that we are, on a relative basis, positioned to help participate and protect. So what we're telling advisors, we're telling our clients, is we are positioned to participate in all outcomes, just like we did last year. If the stock market goes up, we're absolutely going to participate. If the stock market goes down, we will participate in that, don't get me wrong. But we are positioned on the fixed income side to also protect for that. So that is our position there. And if that happens, if the market dislocation happens, the buying opportunity happens, we will be at the ready to rebalance to advantage of that for the long term.
A lot was said. Does anybody have any questions? Let's just pause there for a minute.
Yeah, the question is about how long does it take for the realization of these numbers to come to us within 90 days before we see what happened last month, or?
So we send out, there's a couple of things. Number one, you should be receiving monthly custodial statements as a trust fund commissioner, right? From the
Monthly custodial statements?
Are they on the list?
Well, not as
Okay.
unless requested, we have. I should have asked that as a
Well,
question.
maybe just speaking generally, just as in regular
Yep.
context, is it a couple months before we see like the result of what happened, or is it?
So right now, we are sending this quarterly review out to you and doing it as you would expect here, during the first month of the quarter, targeting between the second and third week of that month. In terms of having access to online data and more real-time data, we are available. Is the trust fund commissioners an advisory board, Paul, to the chair? Say an advisory board or actual trustees? Remind me.
No, we're actual trustees.
To the chair, it's an executive board, so they get the funds. Right, yeah. So, if there's any specific requests of information, it can always be provided. And we can be contacted to answer questions. There's no restrictions on that whatsoever. So, the lag time is certainly not 90 days. Okay? But the next review of this will be nearly 90 days
Right.
to print out. It doesn't mean you get the information in the meantime. Okay, so if you see something happen in the market, and you see the market drop, we are available to answer questions and have conversations.
So through the chair, if I could,
Yeah.
if you wanted to, we have other committees like this established the way you are. We could actually give you access to online data so you could look at it yourself. That has not been requested from this committee.
Yeah.
You do have access to it. We just haven't turned it on, if you will.
Sure.
But we can do that if that's an interest to you. Which, you know, the reporting is not as in-depth as this, but you would have access right away, same day.
Right.
It's up to you as a committee.
Yeah, we'll table that for now. We can discuss it afterward if we don't see the need.
We can send you as many emails as you want.
Oh, great. I don't get
And I respect that, so we don't want to just download you all.
Right.
We work for you, so if that's something the board wants, please let us know.
Okay.
Okay?
Yeah. I think I'm not going to include this meeting, my expression, just saying our next meeting would be after March.
Yeah, through the chair, I think the next meeting is usually April, May, and it's after we've solicited requests for funding, we then bring it to the board for decisions on distributions.
Right. And so just so you know, that meeting is typically pretty consequential because it's typically the meeting where we're funding, I think that's the meeting where we fund a lot of the high school scholarships. Those kind of things. And that's when we get a little bit better sense as to income into a particular trust and what, if any, money we have for distribution purposes. So,
Through the chair, per the request and process we went through last year, this time you're maintaining that stagnant fund list. We'll bring that in for that meeting as well, so you can see
yeah,
payments over the last number of years out of various trusts as well as the current trust status.
perfect.
I believe we're awaiting the direction on which funds to move from account A to account B to try and start separating them out. It was all part of the conversation.
I thought, correct me if I'm wrong,
Yeah.
for the chair, did we decide not to do that, or
Oh gosh.
forget it, I can look at our notes.
Now you're all testing my recollection.
We can look at our notes. We,
Stagnant funds and things, I kind of recall a conversation about that.
Yeah, through the chair, we went through the various accounts to look at what ones were stagnant. I think no decision was made for kind of a universal approach to it.
Yeah.
Other than, I believe last year, there was a request for funds from one fund, and due to the available revenue there, we actually pulled the funds from a different fund that had been stagnant for a bit.
Yeah. I'm gonna pull out our notes while I do that. Commissioner Pitts, do you have any questions or anything for Bartholomew?
No.
Thank you.
I believe, if I go through the chair, my memory, without looking at the notes, there was a lot of turnover, or not turnover of the treasurer's office, I guess,
Sure.
vacancies, so I think that's why it was somewhat tabled.
Yeah.
Now that we have full-time, I don't know if you want to bring that up, but that's totally up to you. The goal was to take some of those accounts called dormant, if you
Yeah.
will, ones that haven't been active, being active defined as spending. Doesn't go through a dormant status with us, so don't worry about that if you're in the banking world. It's not gonna go to sheeted property or anything, so. But it's just dormant inactivity within the account, because these are all commingled funds with the GASB approved accounting report. It all is housed in one account, so there's no dormancy. But there was a list of many that was, many of these dormant accounts that had no spending activity. And your previous two treasurers, I forget, provided that list. We still have access to it. And we can go back and revisit that. But the goal was to
Yeah.
maybe take some of those funds, maybe because of a lower balance or because they haven't been used. Maybe there was two sides of the coin. You would invest those more aggressively so you could build up their balances
Yeah.
so that you could use them.
Well, I think it probably makes sense for us to, if as Mr. McCarthy indicates, we're gonna have a little bit more intel at the next meeting, probably makes sense for us to hold off making any decisions in that regard. I'm just referencing back to our new spending policy, in section 7B discusses this issue of active versus inactive funds. Obviously, it's in more general terms, not specific as to any particular trust fund, but I think, if my commissioners agree, I would say we're not gonna make that identification until we have more information for the next meeting.
Long story short, we stand ready